Hello everyone. We will be talking about the Cadbury Committee today, which was set up by the London Stock Exchange and the Bank of England in 1991. ये कमिटी तो 1991 में सेटअप हुई थी बट इसने एक बहुत इम्पोर्टेंट रिपोर्ट प्रिपेयर की थी जिसने कि पूरा जो कॉरपोरेट गवर्नेंस था उसके अंदर बहुत चेंज लेके आया था वो इसने प्रेजेंट की थी 1992 में This movement for better corporate governance evolved in response to the failure of big corporations. UK was one of the first countries in the world to take a nationwide initiative in this direction after the collapse of corporations like the Maxwell Publishing Group, BCCI Bank, and the Rolls Royce. This committee was set up under the chairmanship of Sir Adrian Cadbury, and the objective of the committee was to look into the financial aspects of corporate governance. The focus of the committee was on control and reporting functions of the board of directors. This committee developed a code of corporate governance which is known as the Code of Best Practice. The code contained the recommendations on the structure and responsibility of corporate board of directors and role of directors. Here I have summarized the main recommendations of the Cadbury Committee in respect to the board of directors, non-executive directors, executive directors, and reporting and controls. So the first recommendation for the board of director was that it should meet regularly, retain full and effective control over the company, and monitor the executive management. There should be clear division of responsibilities at the top of company to ensure a balance of power and authority. It also mentioned that where the chairman is also the chief executive, it is essential that there should be strong and independent element on the board with a recognized senior member. The third recommendation was inclusion of non-executive directors in the board. So the board should include non-executive directors of sufficient caliber and number for their views to carry significant weight in the board's decision. Formal schedule of matters for decision. The board should have a formal schedule of matters specifically reserved to it for decisions to ensure that the direction and control of the firm is firmly in its hand. Next, there should be an agreed procedure for directors in the furtherance of their duties to take independent professional advice, if necessary, at the company's expense. Then all the directors should have access to the advice and services of the company secretary, who is responsible to the board for ensuring that board procedures are followed and that applicable rules and regulations are complied with. Then the recommendations for the non-executive directors are as follows. First one is that the non-executive directors should bring an independent judgment on issues of strategy, performance, resources, including key appointments and standards of conduct. The majority should be independent of management and free from any business or other relationship which could materially interfere with the exercise of their independent judgment apart from their peace and shareholding. Then their appointment should be for a specified period of time, and reappointment should not be automatic. Their fees should reflect the time which they commit to the company. Formal procedure for appointment matter for the board. Non-executive directors should be appointed for a specified period and terms, and reappointment should not be automatic. For the executive directors, the director's service contract should not exceed 3 years without shareholders' approval. There should be full and clear disclosure of directors' total emoluments, including pension contributions and stock options, and those of the chairman. Thirdly, executive directors' pay should be subject to the recommendations of a remuneration committee made up wholly or mainly of non-executive directors. This is very important. The remuneration committee should be made up of wholly or mainly of non-executive directors. Reporting and controls. I have divided this part into two. First, the board's duty, and next, the director's duty. So, firstly, we'll talk about the board's duty. It is the board's duty to present a balanced and understandable assessment of the company's position. The board should ensure that an objective and professional relationship is maintained with the auditors. The board should establish an audit committee of at least 3 non-executive directors with written terms of reference which deal clearly with its authority and duties. Now is turn for the director's duty. So the directors should explain their responsibility for preparing the accounts next to a statement by the auditors about their reporting responsibilities. The director should report on the effectiveness of the company's system of internal control. The director should report that the business is a going concern with supporting assumption or qualifications. So with this, we have finished the Cadbury Committee. Thank you and have a nice day.